Hello and welcome to the Recruit Rockstars podcast, where we focus on the people part of your private equity company or venture capital company. Thanks so much for making the time. I'm your host, Jeff Hyman. Every Tuesday and Thursday, I interview a world-class expert on talent and recruiting so that you can build a company filled with rock stars. I'm a little humble, a little bit nervous today by today's guest because it's very rare, in my experience anyway, that you meet a successful private equity investor who is also extremely successful as an operating leader, a CEO. And today's guest certainly fills both of those categories. If that wasn't enough, he's also got a great new book that we're going to talk about as well. Sonny Vanderbeck is the primary principal and the managing partner at Satori Capital, based in Dallas. We're going to talk a bit about the firm. Firm has about $1.2 billion under management. That's $1.2 billion with a B under management. Invests in portfolio companies with $5 to $25 million in EBITDA. He started the company in 2008, but if that wasn't enough, prior to that, he was the CEO of Data Return. And get this, in Data Return, he raised money from Microsoft, from Compaq, took the thing public, sold it to another public company, bought the company back, as I understand it. So we're going to talk a bit about that journey as well. And then he's got this new great book called Selling Without Selling Out. I highly recommend it, and we'll talk about where you can get that. So with all that said, Sonny Vanderbeck, welcome to the show.
Thanks for having me.
I am thrilled to have you on the show. Let's talk just 60 seconds about the firm, if you will, Satori. And there's so many PE firms. Yours is unique in a number of ways that are very close to my heart. But for listeners that may not know, why don't you share what that is?
Yeah, so here's the big idea. I was running a company that I founded, and our other co-founder, Randy Eisenman, was also a CEO. And we found ourselves very frustrated at our experience with many investors. There were ultimately three things that we saw were wrong. And like any entrepreneur, we complain about it for a while, and then we look at each other and say, well, let's go fix it then. People ask, well, why did you start it? And the real answer is we couldn't help it. We just woke up every day and said, look, this has to exist. And so there are three things that make us different. First, as you mentioned, our background, and this is true for all of our senior team. We have been CEOs and founders and COOs, and we know what it's like to make payroll, to win a customer, to lose a customer, all of those things. And we think that makes a difference, both in terms of the decisions we make and in terms of how we can help our portfolio companies. The second piece is time horizon. The vast majority of investment firms' structures are built around a finite time. You can put a date on the calendar by which they are a forced seller of their equity in your company, and that can create some problems. And so we wanted to build a structure with our investors where we're able to be an investor for an indefinite period of time.
So there's no time period cap at all?
That's correct.
Wow. Okay.
It'd be 100 years. I often say 99 years.
Yep.
The actual truth of it is it's just indefinite.
Yeah.
Because again, back to better decision making, if we're 4 years into an investment and the right choice is, hey, let's open a new plant, make an acquisition, what have you, the traditional path would be, well, we should be hiring bankers now to have a transaction. And our view is, if you just build a great business, the rest of the stuff works out. And so that brings us to our last piece, this idea around conscious capitalism. And I want to explain conscious capitalism as simply as I think I can. Here it is. Profit is not a reflection of what I can take out of a system. Profit is a reflection of how much value I can create for my employees, my customers, my suppliers, my community, and so forth. Right? The companies that are best places to work and their customers love them and they're winning supplier of the year and the communities they're in are happy to see them. Turns out the pattern is those companies also tend to have extraordinary levels of growth and of profitability. So let's not pursue profit. Let's pursue greatness. And let's let that profit be driven by being an extraordinary partner to all of our stakeholders.
There's a lot of discussion around stakeholders lately and how to prioritize them, or do you prioritize them? Do you have a point of view on that? Do employees come first? Do customers come first? Does the owner come first?
A very strong point of view on that it's very, very specific to the business and to the situation. So on one hand, I think you put an important point. All stakeholders are not created equal. What we're not saying is do everything for everybody. What we are saying, though, is if you only have one stakeholder kind of run the tables on everybody else, eventually that breaks. So let me give you an example. If you are in a consulting business, your employee stakeholder is going to be either number one or number two. Just hands down. You're in a consulting business, right? Your whole company leaves every day at the end of the day. And your supplier base probably has very little to do with the experience your customers have, the experience your employees have, and your long-term success. So your suppliers are somewhere down low on the list. They're just not a priority. Turn that to a manufacturing business that buys $50 million a year worth of steel. How important are those suppliers that create the steel that's the input for the product you're making? They're pretty important. You better pay attention. Now, the trick in all this is if you work hard at it, you can often find outcomes that create a win for the supplier and for your customer and for your P&L and for your employee. And so it's really about the mindset of saying, let's take into consideration these other stakeholders when we make a decision, and we'll continue to make good decisions versus short-term bottom line is the only priority, which we think is a failure. And it's a recipe for mediocre results.
How do you, so I assume from that you look for CEOs and leadership teams when you make an investment that share that same point of view. Is it safe to say?
We do, very much. Now, what's interesting, though, is there's a class of conscious capitalists. We think most of the people that do this stuff, they don't have a word for it. There's no presentation for it. They don't call it anything. That's just how we do business.
Yeah.
We find that all over the country that people do good business and they do great things for their employees or with their suppliers. We have a friend who ran a big booking and travel business. Long story short, in the midst of 9/11, they ended up loaning their suppliers, which were hotels, money to stay afloat long enough to get through that process. Now, on one hand, that sounds like complete craziness. You're not a lender. I'm not a bank. There are suppliers. Here's how that pays off. 5-6 years go by, supply is constrained, and those hotels have to decide who's going to get the limited inventory. Guess who they pick?
But you really got to play the long game for this to work, which to your point, number two, I think it was number two.
Yes.
What differentiates you is you do play the long game.
Yes.
So
our belief is that's probably the most important thing, that if you play the long game, then things like the operating experience start to matter a lot. And if you play the long game, caring about all of these stakeholders start to matter a lot.
I give you a ton of credit for that. And I'm sure some of the listeners would say, well, it's easier said than done. So now let's talk about how it's done. So
it's hard.
What's that?
It is hard.
Oh, sure. It's simple, but not easy, right?
Yes.
So when it comes to the people part of the business, what are some of the key observations that you've made over the years, over and over and over, that whether you made the investment or didn't make the investment, that you think differentiate businesses, portfolio companies that make it and hit it big, or those that don't? On the people part of the business, not product market fit or marketing or anything else.
Yeah. So I've got a couple of things that come to mind. One, I had a friend who ran a business that they grew 20% every year for 20 years. Now, the compounding on that is extraordinary.
Yeah, that's very rare.
And I was chatting with him about like what do I need to know? Like, what can I learn from that experience? And one of the things he had to say was, if I'm questioning somebody on my team's capability, it's already too late. Because I've got to grow 20% every year. So I need the people on my team to pull the company forward towards that 20%. I can't do it all myself. So as soon as I start to legitimately question someone's capability to do the job, I know I've got a problem. Then, oh, that's interesting. Like, so that one sits with me a little bit. It's not perfect. It's not always true, but man, it's a fast rule of thumb to say, if you're going to be a high growth company and you're going to sustain that growth over time, the behaviors around people are different than your behaviors in a lower growth company. So here's another one. Let's follow this 20% growth thing. If your company is growing at 20% a year, and you in your own leadership and your team's capacity as leaders aren't also growing 20% a year, your company's going to outrun you or your team.
Yeah.
So it's this big open question of being open to learning and growth and pursuing learning and growth. How do I grow my capacity to lead 20% every year so the company doesn't outrun me? And the same holds true all the way down through the entire leadership team, all the way down to the line. And so keep that in mind as you're thinking about how your team grows and develops over time. If over the past 5 years, you've doubled the size of your company, the people that were really effective 3 years ago, have they grown as leaders as much as the company's grown? Go ahead.
I would say, how do you assess that? So let's say you're considering making an investment or you're considering making a hire. How do you assess accurately their ability to grow and scale as a person? It couldn't be as simple as what books have you read lately. So what do you do?
So a couple thoughts there. I'll talk about some quick rules of thumb to assess the individual person. And to be clear, it's hard and you won't always get it right. One, there's a pretty good correlation for past behavior and future behavior. So what you learned lately? Just tell me what you learned lately, but either on the job or in reading or development or what have you, that changed the way you think about something in business or in life. And what I find is that many people can have a real dialogue about, oh, I learned this thing, either a mistake I made or something that works, and I saw a pattern. And so just ask the question, what'd you learn recently that changed the way you behaved or changed the way you looked at the world? And the point there is these patterns do show up. People that are learners tend to be lifelong learners. It's not an episodic thing. They didn't do one thing. You can't see much over here, but you'll see stacks and stacks of books around our office. I buy them faster than I can possibly read them. And that as a core value at Satori, curiosity, we use different language for it, but in essence is curious. Find curious people.
Yeah.
Which
not everyone is. I'm surprised often to find that not everyone is curious or feels that they want to grow, right? I grow till I'm 30 and then I can level off and just kind of do my thing. And that's not how the world works if you're going to be in a 20% growth business.
That's right. And that's okay. Like people that want to relate to the world that way, that's fine. And there are roles for them. But that person who's vice president of engineering today that has that mindset isn't your vice president of engineering 3 or 4 years from now. That's really the essence of it. And I actually built a tool to help quickly figure this out. You want to talk through it?
I want to talk through the tool after I ask you one question.
Okay.
As the business scales and you, the leader, say, you know what, the business has outgrown this person or is quickly outgrowing this person and their ability to scale. How do you make the change, which is your job, without disrupting the DNA, the culture, the fabric? When the person has been loyal, they got the thing from 0 to 20 million. Now you need to go from 20 to 40. How do you make that change without upsetting the apple cart?
To be clear, the apple cart's going to get upset a little bit. It's hard. It's never easy. No matter how many times I've done this in my career as an executive or as an investor partner, I actually don't think it gets any easier because there's a human dimension of this. And to be clear, I don't even always get it right. Just because I can observe a thing and go, oh, that needs to get sorted out, I'll make my own excuses about why now is not the right time. And so one of the things I watch for myself is when I start piling up the excuses about why not, that's a good sign for me to go, hey, man, you got to go do something about this because you're starting to justify your own bad behavior. But it happens and it's hard because, to your point, they're loyal, they worked hard, they try hard, they haven't done anything wrong. And I think that's a really important part of the framing of.
It's easy if they steal or, kill somebody, then it's easy to make the change.
But so here's the framing there. We'll go back to the one we used a little bit earlier. The business has outgrown you in this role. And so one of the things that's interesting is I've often found it's not that that's time for that person to go. They just have the wrong job.
Yeah.
And
If
so
the business is big enough to have different roles to move them to, that's great.
Usually it's the growth of the business that creates the problem.
Yeah.
And so you say, look, you are the VP of engineering. It's clear that your passions lie in actually engineering innovative solutions around a small team. And so we want you to lead the engineering product development team of 4 people instead of manage 100 engineers.
Right.
And I would say more than half the time when you get into these conversations that are effectively demotions, they're demotions. The role has outgrown them, and they're going to have a new title. If that person's honest with themselves, they will breathe a sigh of relief in the meeting.
Yeah.
That they wanted to be loyal and they were trying, they were failing, and they knew they were failing, and they knew it wasn't working, but they didn't want to let you down, or they didn't want to let the company down. And so now they're happy and excited. There's some ego. There will be some ego in the mix, and some.
You got to let them save face with the rest of the team.
Some practical kitchen table stuff.
Sure.
I'd argue it's not always worth fiddling with comp in that change, especially in the first year, because it's just expensive to trade them out. You've got somebody who is values aligned, is loyal, they fit the culture. They just can't perform.
Yep.
So you have the conversation. But remember the framing on the conversation. This is what we haven't said is you're a poor performer. We haven't said you're a bad person. We haven't said we don't want you here. We've simply said the company outgrew you in this role. Let's find the great role for you in the company. So it's a different conversation than it's because it's not really even a performance counseling. It's not try harder.
Right. It's just more a fact that there's not a match. There's a disconnect between you and this role. Let's find another role where the match would be great again.
Yeah. It's certainly easier for me as the deliverer of it than the recipient. I'm very aware of that.
Sure.
But so it's interesting because you get enough of those conversations, and to our brief mention earlier, I ended up making a quick tool around
this. That was my next question. So walk us through how it works.
And so here's the idea. It's called red, yellow, green.
I like it already because it's at my pay grade.
It's just really straightforward. And so here's the deal. Print out your org chart. And my advice is to actually print it out on paper.
Yeah. If you have one, which is another issue altogether.
If you don't have one, you should probably do that first. I promise you, if you don't have one, you have problems.
Yeah.
Print your org chart out and go through with green stickies or a green marker. And I want you to mark everybody who's going to be capable in their current role at twice the company's current size. Mm-hmm. So it doubles, and you're like, no, they're going to be good when it doubles. Those are your greens.
So let's pause, because I know some of the listeners may have been saying, I do this. And what they probably do is assess the person in their current role.
Exactly.
Let's be really clear. Their current role times 2, are they still a green?
A double it.
Yeah, double.
So,
okay. Yep.
So if you can do the job at the company's current size in your current role, you're a yellow.
Okay. Yep.
And here's why. If the company keeps growing and that person doesn't have a development plan and they don't continue to grow, they're not going to be yellow for long. The company's going to outgrow them, and we're going to have the conversation we just talked about.
Sure. So the point is not looking in the rearview mirror to manage these green, yellow, red ratings.
That's right. So let's talk about red. Red are the people who were entirely capable at half the company's current size. And it's real. It happens. Like if you've got a growth business, so the funny thing is when I talk to CEOs about red, yellow, green and take them through this, everybody knows who the red is. How is that a thing? Like when I take you through it, like you could talk to different people on the team and everybody knows the red one. And no one, I don't hear gnashing of teeth from CEOs about, well, I'm not sure if I have a red. They're like, oh yeah, Jimmy, okay, we got to go deal with that. But it's a new framing. And the new framing is not Jimmy's bad. The new framing is he was great at half the company's current size. And so as you might imagine, there are 3 conversations. The conversations with your green are you're extraordinary, you're high potential, and I'm going to start putting more work on you. And it's because you have so much potential. So you're getting tapped for special projects. You're getting tapped for XYZ. When you see those come, it's because we believe in you. The yellows are, you're awesome. Here's how fast the company's growing. We want you to continue to be successful. Let's talk about how to develop you as a leader, and let's build an actual plan so that you grow at least as fast as the company's growing.
Yep.
And the reds are the conversation that we just had of, look, we got to be in a new role, change behavior, or you got to go. And so you can do it in 5 minutes.
You can do it. Why don't leaders do it? Why don't leaders in your portfolio or other companies you've dealt with, why aren't they doing this anyway?
It's hard. It's hard emotionally. It's hard because we don't actually really have a tool for it. And, most performance reviews aren't very good. They tend to be too tied to comp anyway. And generally, most cultures don't give real feedback for somebody that's falling behind. Like, it's just like, you never want to have somebody that's let go where it was a surprise.
Right.
That means you have to have given feedback along the way. And I think a lot of times these pockets show up in parts of the business where, like, the hardest thing is the C plus, right? It's tolerable. That's why they sit, because the situation is tolerable.
It's not so bad that they have to get rid of them today,
right?
But it ain't going to work over time.
Yeah. And it's not pulling the business forward. It might be something that's holding it back a little bit, but it's not a core key. Like, look, if your VP of sales is a red and you're behind on revenue targets 2 years in a row, you know what you need to do and you're going to fix it. But it tends to hide out in pockets.
What I love about this, Sonny, is that it's forward looking as opposed to the current team, which is if a leader does assess their team, that's how they're probably doing it today. You're taking a totally forward looking approach. Who's going to grow faster, the company or the individual? But what do you mean by grow? So give the listeners an example of, it's not just giving them a stack of books to read on a weekend. So what does growth of an individual look like?
Wow, that's somebody's written a book about that, I bet. So I think growth can take a lot of dimensions. But the starting place is actually it's the mindset in and of itself. It's a little bit like, and I won't go off too much on neuroplasticity and the sort of mindset of a learner, but somebody who's learning anything is also going to be learning from the market, learning from competitors, learning from customers, learning in conversations with employees. They're going to learn new things every day because they're willing to see the world in a way that's different than the belief they had when they walked in the door, right? And so what's the other side of learning is, do I have a fixed mindset or a growth mindset?
Which is a phenomenal book and concept, even for being a parent.
Yes. And so that the growth and development could be on lots of angles. I'll give you a tactical example. And this happens particularly down lower in organizations. Unless you have been at a company that had an extraordinary system and training and set of feedback on here's how to coach an employee to higher levels of performance, whether they're good performers or bad, where were you supposed to learn that?
Yeah.
Really?
Yeah.
Okay, let's train people how to actually give good feedback to their teammates. So there's a tactical example. Another tactical example might be, and I see this one very common, financial literacy for business matters.
Yep.
Right. And so what I find is in companies in the size we work in, which are usually, call it 100 to 1,000 employees, probably centers around 100 to 500, the majority of the director level and above team that don't work in finance or are a general manager are not really comfortable with financial statements.
Yeah.
And so what happens is, and this happened in my operating business, my COO said, okay, enough. I'm actually going to run a class and teach everybody not just how to read a P&L, but what the implications are on the balance sheet and all of these things that seem like they don't matter.
Sure.
But it changed the decision they made. And so they were able to make better decisions every day as a result of having this, I'll call it horizontal knowledge. These are tactics like reading financials or giving feedback. And then there's sort of different level stuff that's learning like, hey, the way I make sense of the world and the language I use, other people make sense of the world in a different way and use different language. As a leader, the more I can use the language they're comfortable with
Sure.
to communicate, the better communicator
So
I'll
it's
be.
ways of developing your EQ
Yes.
as a leader. I love the example you gave around financial statements and teaching that, because my first job out of school was at Black & Decker, and we had a president who every quarter would literally for an hour go through the P&L, the balance sheet, how it works, not just the numbers, but how they work. Now, he dumbed it down so that everyone would get it, but it was phenomenal.
That's awesome.
It really taught people's eyes opened up.
And I think that's rare. It's easy to say, well, we're busy. We got stuff to do.
We don't have an hour to teach people the financial statements.
And I would suggest to you that if you build capacity and capability in your team, all of those things you're trying to accomplish will get easier and they're more likely to get done.
It's Sharpen the Saw by Stephen Covey, basically, right?
Funny how we're still talking about the same stuff 30 years later.
Yeah, we'll never get it. Sonny, I can't thank you enough for making the time. Before we wrap up, I want to touch on your book. You've got a phenomenal book, and not a lot of private equity folks see themselves as an author, but I think you had a very important message to share. Can you give kind of a quick overview of the book and then how people can get their hands on it?
Happy to do it. So as you mentioned earlier, the book's called Selling Without Selling Out. The subtitle is How to Sell Your Business Without Selling Your Soul. So here's the gist of it. The process of taking an investor on or selling your company, most of the players in the mix care about the transaction and the money, and they don't care about anything else. They don't care about your values. They don't care about your legacy. They don't care about what happens the day after. And I think that this idea of the day of closing is not nearly as important as the day after is really the central idea. And so here's the gist of the advice.
Much as an IPO is the first day, not the last day, right?
That's right. That's right. And so just figure out what you care about besides money. Is it employees or brand or legacy? And I have no opinion of what people should care about. I just suggest find the things you care about and write them down. And here's some tools and techniques to be able to use those in a conversation with an investor or an acquirer to figure out if they're a good fit or not.
Before the transaction. So
before the transaction.
Got it. Okay. Got it.
There are very few irrevocable decisions we make in our life.
Yeah.
And I sold my company to a strategic, and now I can't stand life as a business unit leader, and they're treating my companies poorly, and they fired half my employees. Those are usually one-way decisions. Like, if you're going to find yourself in that situation, at least know that's what you're getting into.
Right.
And so that's the idea, to be able to equip CEOs, owners, leaders with a roadmap to getting whatever it is that they want and whatever it is that they value. I think I can help you get that in your next transaction.
I think a lot of founders and CEOs don't understand how quickly all their years or decades of hard work can be undone when they sell to the wrong acquirer, because they held out for the highest multiple or some other provision or term, and then they really regret it. And like you said, you can't undo it.
Yeah. So if you can figure out what matters, then you got a decent shot at getting it. So you come to my website at sonnyvanderbeck.com. You can see the book there, a bunch of tools available to help facilitate the process. And happy to be in conversation with anybody if I can make a difference for them.
Sonny, how can people learn more about Satori?
SatoriCapital.com. Come there. Or you can send me an email directly at sonny@satoricapital.com.
One of the most approachable, probably one of the nicest. Maybe it's because you're in the South. I don't know. Is that maybe?
That helps. I'm from Texas.
There you go. Thank you so much for making the time, Sonny. I really appreciate you sharing your wisdom with the audience.
Thank you much.